you see them come in, tell them go that way, okay, so they don't distract me. So you have the outline, so if you could just follow along, that'd be great. I don't mind if you're still working on stuff while you do this, but when I do the final exit lecture, you got to turn off your computers and turn off your cell phones. I need all your attention, okay? So let's just go through, where's the market today? Where's the Dow right now? I already looked at it this morning. Where is it right now?
Down
How much? And you got to do this quick.
24,448.
Okay, by how much? How many points?
580.
So it's down over 500 points, so something's happening, right? If it goes down 1,000, something's happening. So anything happening? You know, George's funeral was yesterday, so everybody was a little bummed out, so they came back and they started selling their stock. I think a lot of it is really the trade war. Where's the oil today? Where's oil trading per barrel?
Down.
Yeah, I know that. To what and by how much from the peak? Come on, as fast as possible.
50.
What is it?
50.
It's down to 50. It's down 22 points from its peak at the beginning of the semester. Where's gold per ounce?
It's 1,200.
Is it up or down?
Up 4.4 points.
What would cause gold to go up?
Uncertainty.
Exactly. Give me one more. Is it a commodity? Is gold a commodity?
Yeah.
Okay, so if gold prices are going up, what does it tell you about commodity prices? They're probably going to go up. And if commodity prices go up, what's that called? You got it, inflation. So where are bond yields today, especially the 10-year Treasury? And where are short-term interest rates? What have short-term interest rates been doing? What happened 2 days ago? What?
Bonds are down.
Yeah, so what's the yield on the 10-year Treasury?
2.84.
Why would yields be going down? What does that tell you about future economic activity? If yields are going down, what's happening? What's the expectations? If interest rates are going down using the Fisher equation, what's the number one factor that would cause interest rates to fall? Using the Fisher equation. What's the number one factor in the Fisher equation that would drive interest rates lower? What's the number one factor in the, I'm going to just keep asking the question until you get it, because I probably asked you this question 50 times in this
10-year Treasury going up.
Why would cause the 10-year Treasury yield to go down using the Fisher equation? What's the number one factor? What? Using the Fisher equation, what's the number one factor that would cause interest rates to go down? Let me try this with you ladies. What is the number one factor in the Fisher equation that would cause interest rates to go down? What, excuse me? What? Can you speak up? I don't think they can hear you. Inflation what? No, inflation what? Expectations, got it. Okay, and where is the dollar to the pound, dollar to the euro? Don't worry, ladies. Accountants will know this stuff. All the CPAs will know this stuff. Okay, go ahead.
To the euro, it's 1.13.
Up or down?
Up.
What would if the dollar to the pound is up? Did the dollar appreciate or depreciate? Okay, let me try that again. If the dollar to the euro went up, did the dollar appreciate or depreciate? Okay, if the dollar to the pound went up, did the dollar appreciate or depreciate? Appreciated. And what about the pound of the dollar? Say it. Appreciated. Okay.
Yeah.
Okay, so those are the economics. These are all oral exams, basically. Okay, to test you to see if you've been following along the whole time and if you've been paying attention. Okay. Okay, and you can do your makeup work, and the leader of the group hands in the PowerPoint presentation, and the leader of the group has to write me a note, basically giving me an assessment of the other team members within the group, basically telling me if they participated at all in the construction, in the production of the PowerPoint. Okay, 'cause every semester I get a few people that do the presentations and don't really do anything, and I need to know. Okay, you can't hide from me. And then if you want to check your grades afterwards, you can. Then we're going to do the big short with whatever time is left. And apologize for the technical difficulties. I'm going to go through the course review. I'm going to do the exit lecture, and then you're going to give me the deliverable 3. And then you're all invited to Dr. Larry's Burger Fest, at the Metro that I throw at the end of every semester, and I should get a good turnout this year too. My other classes are pretty excited about it, and I'm inviting some of my friends, so there should be some good networking opportunities, and if anybody's interested in internships, especially the marketing people, I have a marketing internship that I'm looking to fill, and I could probably get hire at least 2 or 3 paid internships. The guy's coming today, he's totally filthy rich, and he wants to do some stuff with my students. So let's get into what we learned over the semester. First thing, we already did the capital market updates. The capital markets, the updates were totally critical of the applied component of the class. You came in almost every single class to basically test your ability to be able to track the 5 major asset classes, what causes the asset prices to go up or down, because they move every single day. And the most important thing about this whole exercise is you will be exposed to stocks, bonds, oil, gold, and currencies within your career and in your life, because where else are you going to accumulate your wealth than in those major asset classes? You'll probably start your own business, and you'll probably invest in real estate also. So the exit lecture will get into a lot of that stuff, and the key component of the exit lecture is to give you some intellectual infrastructure where you can make decisive decisions and not lose your money. Because you will some of you in this room will probably lose your money because somebody's going to steal it from you. Either it's going to be your relatives or somebody, your business partner, but definitely the government's going to steal at least maybe half of everything that you make unless you're really, really smart. And I'll give you some advice on that too. The first thing we did in the class is we started with quantitative analysis, the statistical analysis, the statistical review. It doesn't matter anymore what major you are. They want you to know programming and they want you to know statistics. I'm sorry. It's just the way it is. They look at all the job applications now and they all want quant and they all want some kind of big data application, either R or Python or Tableau or SQL or something like that. We first came out and talked about large data sets. And if you can normalize the data, filter the data, you can get to normally distributed distributions. Then you can apply the variance analysis, you can apply the statistics, get the information, and then make decisions. And that's the way businesses do it. I'm sorry, this is the way we do it. We learned how to calculate geometric and arithmetic means, and you know that arithmetic means are basically influenced by outliers. Okay? So you're going to have to do some kind of filtering process. And we have problems with outliers, which you probably almost always do have when you're dealing with large data sets. Distributions, we looked at different types of distributions, skewness in the distributions. We talked a little bit about how you normalize the distribution using z-scores. Central tendency, median modes are the 3 major components of central tendency. Data analysis and data visualization, we looked at box plots and the stem leaves, etc. We talked about volatility and risk and variance and standard deviation. And if you take advanced marketing research or if you take advanced classes in investments, you're going to be using standard deviations a lot, in a lot of the equations. We talked about model variable testing, model testing, F&T tests. We talked about building multiple regression models, both time series and cross-section, and how cross-section regression models can be used as an interim solution to time series until you have enough data to be able to apply the time series. We looked at coefficient of variation, which is the standard deviation divided by the expected return, and then if you flip it, you get the risk-adjusted rate of return. And if you subtract out the risk-free rate from the expected returns divided by the standard deviation, that's the Sharpe ratio. So it's another way of adjusting the returns. And we talked about covariance and correlation, and if you get low correlation and covariance, you get diversification, within your portfolio. And the portfolio can be stocks, bonds, multi-assets, it can be divisional lines within the corporation. It doesn't matter, it's the same concept applied across all business decisions. We talked about multicollinearity, where you have variables, multiple variables in your model that are highly correlated to each other. You don't need a bunch of variables in there that are highly correlated to each other. You just need the variables that in there that are highly statistically significant and have been cited the most within the literature. So that's your external validation. Internal validation is if you're building models and you're collecting the data and you're doing the analysis, and you're basically talking and communicating the results to senior level managers, you need them to buy off on your model and buy off on the results. And that will be the internal validation. And a lot of the people you're going to be working with will have years and years of experience building these types of models. So you need them to basically buy off on your approach and your results. We talked about systematic risk and unsystematic risk. Systematic risk is macro level risk, market risk, political risk, systemic risk. There's lots of definitions for it. And unsystematic risk could be real estate specific, business specific risk. And the larger your portfolio, that unsystematic risk gets diversified away, so the only thing that's left is the systematic risk, and systematic risk is basically reflected in the beta, okay, in the beta, particularly in the CAPM. We looked at financial ratios and financial ratio analysis, and obviously the ROE is probably the most important financial ratio for the equity investors in particular, but also the debt to equity and the debt to total market cap, interest coverage and ROA. All of those ratios are extremely important when you're comparing them against a direct competitor peer group in the industry to get an overall financial condition and position of the firm. You learned how to calculate WACC in the capital asset pricing model. What's the capital asset pricing model? What's the equation? What's the CAPM? You gotta know. You gotta know it. What's CAPM? I'm not gonna waste my time. You should know it. You have it tattooed on your ankle. What's CAPM? You gotta memorize it.
Expected rate of return equals risk-free rate plus beta times market risk premium.
Yes, and what's the market risk premium? How do you calculate it? I don't know. Return on the market minus the risk-free rate. Okay, you gotta memorize that stuff. I get people going into interviews all the time, and they say they ask me what CAPM was. They ask me how I would calculate a standard deviation. Give me some writing samples. Show me a PowerPoint presentation. Show me a writing sample. Take this test. Talk to these people. If you plan on getting a job, you gotta know this stuff because you're a business major. You gotta know everything you learned in your classes. We learned the different intrinsic valuation methods, the perpetuity, Gordon growth, the multiple DCF. On the quiz, you learned about unorthodox monetary policy and the effects on discount rates. The yield curve inverted 2 days ago. The yield curve inverted 2 days ago, second time this year. It's already inverted in the emerging markets around the world. You already know that if the yield curve inverts, what happens in less than 12 months? No, that's 24. What happens in less than 12 months when you have an inverted curve? You studied this on
The market peaks?
yeah, the stock market peaks in less than 12 months, and you're in a recession in less than what? 24 months. Is that good to know?
That is great to know.
It's great to know. We learned about yield curve dynamics, yield curve theory. We looked at the dynamic yield curve. We looked at the shape of the yield curves. If it's inverted, the inflation expectations are negative. If it's flat, they're zero. If it's upward sloping, you have a positive inflation expectations. The curve's inverted. We looked at other market indicators, the factors impacting the markets. We did the supply-demand analysis. Some of you didn't do that well. I checked some of your grades. Some of you didn't do that well in microeconomics. Some of you did do well in microeconomics. This is just a review of microeconomics in an applied setting. And we looked at the factors that would cause the supply curve to shift back or out, or the demand curve up or down, to be able to determine, based on theory, how to forecast where these asset class prices are going to go in the future. We looked at financial product innovation, how to design these products, development, environments, engineering. We looked at S-curves and product adoption cycles, which are all applicable and all discussed by experts out there. We looked at the fundamental or institutional foundations or factors that actually could drive product innovation within the firm. You need to understand that. You won't get that piece of it. That whole lecture right there, you won't get at the undergraduate level. Usually you'll get it at the graduate level. I brought it into the undergraduate level because I felt it was too important to skip over. We talked about modern and postmodern portfolio theory, utility curves, capital allocation line, efficient frontier, and when they're all tangent, you have the market basket. and at that point you have the highest risk-adjusted rate of return. You can bow out the efficient frontier by adding alternative assets whose returns have low, no, or negative correlation with stocks and bonds. And the allocation is the insurance, the renewable energy, and the real estate. And the insurance is the most amazing product and probably the most beneficial financial product ever invented over the last 167 years next to derivatives. Because when the principal passes away, the estate gets the life insurance death benefit, and the beneficiaries of the estate move up onto a higher utility curve, which is where they wanted to be originally. Okay, that's the only way to get there. Okay, by the application of the insurance. What else? The bowing out of the efficient frontier is extremely important, because not only did I reduce the expected return on the portfolio, but I significantly reduced the standard deviation of the portfolio. So my risk-adjusted rate of return went up through diversification effect. That's the modern portfolio theory. I can also bow out the efficient frontier through the use of financial engineering, through the application of the derivative contracts as portfolio insurance to the portfolio. And as we know, if I want to apply portfolio insurance, because I think the values are going to drop, then I'm going to write the forwards, write the futures, buy the puts on the futures, and basically write the calls on the futures. And then maybe go short and write calls and buy puts. My stock and my ETF components. So that financial engineering application also goes out the efficient frontier. Okay, and that's the postmodern piece. Derivative trades. We memorized derivative trades, and we were introduced to derivatives right in the first 2 weeks, the first 3 weeks of the class, because it's the most difficult component. I wanted to train you on being able to apply those derivative trades, but apply them in a trading memo. Those trading memos are basically business trading memos that you would submit to your managing director to be approved to trade to trade on those markets. Okay. Obviously, or unfortunately, we didn't have enough time to actually test and get into the mechanics of the derivative trades. The derivatives are adopted by most hedge fund managers and adopted by corporate finance departments at the major banks and financial institutions. We looked at technical analysis, trends, sideways patterns, accumulation, consolidation, breakouts to the upside, downside. You listen to Bloomberg or any financial news network, I would recommend Bloomberg. They use technical analysis in conjunction with fundamental analysis. And when you listen to them articulate, they're talking corporate finance, marketing, everything. They're using all the business language, but focusing on technical and fundamental analysis to help guide the investors on where to place their money. We learned intrinsic valuation theory, perpetuity, where the cash flows basically remain constant into perpetuity. We learned the Gordon growth model, which assumes that the cash flows are going to grow at a constant rate. We learned the multiple approach, where you're basically applying a multiple to the cash flow. You can use the multiple approach too, not only in valuing the securities, but valuing real estate and companies in the same way. And we also learned that we can create multiples by dividing 1 divided by the discount rate, or 1 divided by I minus G. Or we could go and observe multiples in the marketplace, apply them to the cash flows to get the intrinsic value. The multiple is an extremely valuable approach for valuation purposes. And then we learned about the discounted cash flow approach, which is appropriate for stabilized companies and stabilized environments, but you really can't use the DCF or the Gordon growth or the perpetuity for startup companies, because they're all priced off of multiples. We did problem sets, ROA. We looked at the DuPont model. We looked at investment decision-making and capital budgeting. That's where the investment decision-making matrix comes in, which is extremely important. During the midterm, we just focused on case studies, applications. We didn't dive into the pro formas or the financial statements. You'll probably get that in your financial accounting. That was the piece that was missing, but I could have spent a couple of weeks on pro forma and income statement construction, to drill down to the NOI or whatever we were using to discount back. We did applications and investment decision making. We presented ourselves as a venture capital or private equity firm acquiring startup companies, or even established companies buying startup companies, which they do a lot these days. And again, focusing on the perpetuity, Gordon growth, multiple, and DCF. And again, in the venture capital space, you're using multiples. We looked at established tech companies, applying the same intrinsic valuation methodologies, perpetuity, growth, growth, multiple DCF, but we focused on the DCF for the established firms. We also looked at valuing established tech stocks, publicly traded real estate investment trust, securities. We also did a commercial real estate development modeled after Salesforce Tower in downtown San Francisco, and the mixed-use commercial, residential, retail, and medical, biomedical with a research institution anchor was basically Mission Bay. Okay. The midterm continued applications and investment decision-making, both theory and applications. We walked through the four iterations. The first iteration is just to discount the cash flows, get to the present value, subtract out the cost, and if the net present value is positive, then you accept it. That's pretty easy. But if you get a negative net present value, you got to go back. First thing you do is ask for a price reduction in the amount of the negative NPV. If you can't get it, you got to go back and review all of your assumptions. If you still get a negative NPV, the last thing that you can do is calculate the value of a real call option. And we know the three factors that drive the value of the call options is management decisions, time, and volatility. Okay? And if you do get a value on the real call option that is equal to the negative net present value, your net present value is 0. And if the value is greater than the negative net present value, you get a positive net present value. In both conditions, you would accept the project. But if you get a negative net present value, you reject it. That's the last thing you can do. And then the final is just a continuation of the applications and investment decision making. Again, reviewing the investment decision making matrix. I gave you security and an investment. So if you didn't learn it the first time, you should know it by now. And then the last piece was the Goldman Sachs application into the intrinsic stock valuation, where you came up with the final intrinsic value based on the scenarios that you use, based on the intrinsic valuation methods. Based on that, you made the recommendations, buy, hold, sell. And then based on those, you made the trade recommendations that you would give your proprietary trading unit, your clients, or maybe the investment committee, or whatever situation that you're in. And then lastly, I reviewed your resumes. Hopefully I reviewed your resumes. Again, if you're not going to go on and get a job, then you didn't need to give me a resume. You were already retired, right? So you have nothing to worry about. But if you did work with me on the resumes, I hopefully improved the resumes and get them so that they would stand out in any competitive interviewing process for an internship or a job. They do work, and usually if you go through me and Mary Beth, we can fine-tune those things to help you distinguish yourself amongst your competitors. And that's where working with me and putting in the production metrics, number of people called, number of clients served, amount of revenues generated, all of those things. Nobody does that. If you do that in your resume, you're going to stand out. With the book, we basically use the book as a resource, using homeworks and extra credit problem sets to help reinforce a lot of the underlying concepts in a more detailed fashion. Hopefully you took advantage of that. We used the Fundamentals of Corporate Finance, which was the Perino book, which has been said as one of the best books out there. And if you use the Wiley Plus application, the narrated PowerPoints and Excel spreadsheet narrations, you really know your finance. You're gonna have no problems whatsoever. We went through all of the chapters, the role of the finance manager, the financial system interest rates, financial statements, financial statement analysis, time value of money, discounted cash flow, risk and return, bond valuations, term structure of interest rates, stock valuations, capital budgeting, cash flows, project economics, cost of capital, CAPM, WAC, working capital management, new venture capital, bootstrapping, seed financing, go to venture capital, get your venture capital, get taken out by a private equity firm, by a corporation, or take your company IPO and make more money, right? And then leave and retire at 35. Capital structure, optimal capital structures, that's going to minimize the weighted average cost of capital. If you can maximize your internal rate of return and minimize your weighted average cost of capital, that spread, or that economic value add or market value add, if you can maximize that, you're going to maximize the value of the firm. And that's what all CFOs and CEOs really focus on is that spread, okay? Either in dollar terms or in percentage terms. If you over leverage the firm, your cost of your equity and your cost of capital goes up, the cost of the debt goes up too. People over leverage their firms to juice the return on equity. At some point in time, you've over leveraged the firm, your cost of debt and equity goes up, and now you're destroying value, okay? So we look at that a lot as analysts. We talked about business structuring and formation, valuation, financial planning, growth on the structuring standpoint. Most people will start a company. If they do it as a sole proprietorship, you're totally liable for everything. If you set it up as an LLC, you're asset protected with the LLC, and it's a pass-through vehicle, and you basically just pay the taxes, whatever the income tax rate is. Most companies that are growing very quickly and large, they'll become C Corps. There's a lot you can do with C Corps, and if you ever want to sell out your company, or if you ever want to go public as a C Corp, it's a lot easier from a financing standpoint. And then in chapter 20 and 21, we looked at options again, and we looked at international finance. And how did I use technology in the class? Well, I used the course website is basically the portal for all of the resources to be able to create a channel for you to basically access those resources. So there was really no reason why you couldn't really keep up in the class, because I gave you the answers to the extra credit problems set into homeworks. So you weren't struggling to try to figure out the homework problems, wasting time. You could do the problems and then go back and check your work, or you could follow along, do the homework, and see how to do it the right way. And hopefully you memorized it, not just copied it. Because if you copied it, you didn't learn anything. But if actually you were learning, as you were doing it, you were learning how to do stuff the right way. That's usually the way I learned. And a lot of stuff, tell me the answer. Don't make me figure it out. I know how to learn finance, okay? Sometimes I can't teach you finance, but I can teach you how to learn finance. And that's how I did really well in my classes, as I went to the solutions manual and memorized all the questions and answers. And then when I got into the testing environment, I knew exactly the structure on how to apply the answer, and then it just became inputs. And if I even made mistakes on the inputs, at least the structure was there, and I got basically credit for the most of the problem, even though the final outcome was not exactly correct, but I had the structure right, and I got extra points, and I was able to get into the B8 category just by doing that. I used announcements, and I used email as communications. I encouraged you to call me. Most people don't. I think your generation doesn't call people, you text people. You should start getting used to calling people, because you're going to be calling a lot of people when you graduate and get into the business world. Email is fairly effective, although it's a myopic form of communication, but I did use it. And texting is extremely effective, because I don't know if you noticed, if you ever texted me, I got right back to you probably within 2 to 20 minutes. Okay? It's because I want to solve the problem as quickly as possible. And usually what I'll do is I'll get a text. If I can solve the problem instantly within the text, that's great. If not, I called you, okay? Because I can't communicate via email, and I can't communicate via text. It's totally inefficient. I can solve the problem in less than a minute over the phone. It's going to take me 2 minutes just to craft the email. So I'm wasting time. I did a lot of in-person meetings. I gave you all of my office hours and made myself extremely available to you, and I did get some comments from some students that basically said they learned the most by coming and talking to me on a one-on-one basis, because that's when you learn. And hopefully, I hope to God that you have really good executives in the companies that you go work for, and your supervisors and your managing directors will spend time with you to train you and to transfer the knowledge to you. If they don't do that, they're probably not a very good boss, or they just don't have a lot of time. But I learned all of my stuff from really good bosses. And I had some great bosses that taught me how to write and write those memos, taught me how to do these PowerPoint presentations, taught me a lot of the stuff that I taught you in this class, so that you don't have to make the mistakes that I made, and be able to accelerate yourself and really get you prepared to make that transition from the academy into the work world more smoothly. And that was basically the goal and objective of the course. Is there any comments or suggestions? What worked and what didn't work in the class? What can I do to improve the class? I'm always looking for constructive or critical feedback. I can handle it. And again, remember, you're gonna be in rooms, and you're gonna be in meetings, and they're gonna expect you to engage. Okay, and this is a great opportunity to get over your fears and start becoming a little bit more vocal and engaged in an uncomfortable situation such as this. Go ahead.
I think it might help if you went a little slower sometimes.
Okay, yeah, I talk really fast.
Yeah.
Yeah, I go really fast. Yeah. That's one of my problems. Yes.
Less paper,
Less paper, and then how would I get around that?
use more digital forms, or
Yeah, but how do I get people to do the work?
what do you didn't have
Students
to
don't,
use-
I found, and they was told that they don't read the book. And that they, and I don't mind them working together on projects and stuff like that, but you need to like write stuff down when you type stuff in. It doesn't have the same cognitive imprinting that you do if you write stuff.
Yeah, you gave us a 10-page outline for this final class, and you were probably going to post that online.
This?
No, what you just lectured.
Oh, yeah, absolutely.
So like, if we have that online, then
And then you go back and you basically use this as a training like I did when I did the test prep videos. You come in, you take really good notes, you study from the notes, and then you come in and you take the exam. I was trying to get it so that I could boost everybody's performance in the class. I get about a 95% success rate, if people produce the actual physical documents. If I don't do the physical documents, then I gotta resort to intermittent episodes of assessment, such as exams, and then that skews the distribution. So my theory on the amount of paper and the amount of work that you put into these things is that it's reinforcing. You have actually a tangible product. You have physical products to reference, and you don't have that obstruction or that barrier, that fear to go log on. So by giving you the piece of paper, you don't have to log on and go through 2 portals. And some people, I don't know about you, but some people use those objections to basically, or those obstructions, to not go do the material, not read it. And I've heard it. I've heard it that some of you guys don't read the book, okay? You don't read the book. You try not to read the book, okay? I've heard stuff like that. You want it easier. You want stuff easier. And then if I do the assessments, the intermediate assessments, and I get failure rates of 50% of the class, then at the end of the semester, and I continue to progress, you didn't learn the material, and then I feel sorry for you at the end of the semester, and I end up elevating your grade on some kind of bogus curve approach, and you end up graduating from the class without learning the material. So that's my rationalization on how to,
fair enough.
that's just my rationalization. But I'll take that into consideration. That's what I wanted to do with the Wiley Plus, by providing you with the ability to get the narrated, PowerPoints and get the narrated Excel spreadsheets. I don't know if anybody even used Wiley Plus. I don't know how many people actually read the book. So I was just trying to push out content to make sure that you actually read it and reference it. I know it's old school, but we have a rich school, okay? They can afford for me to basically provide you with that information. But I'll take that into consideration once we build an application on your phone, so that basically you can pull up the notes and interact in the course website through an application through St. Mary's. Then I'll do it. Okay. But until I get the application, I'll still be paper intensive. I'm old school. I've been doing it for 25 years.
I was gonna say, it's really helpful that everything is online, because we are able to reference to go back. However, like sometimes trying to find
Yeah.
like specific homework and stuff, so like, cause you put all the YouTube videos up, which are really helpful, but, like trying to find specific ones are kinda difficult. So
Yeah, I
like,
didn't
putting
spend the
things
time to
putting them in
basically put
yeah.
the notes on them.
Yeah,
I
putting
should
them
do.
into folders, that would be like kinda helpful.
Yeah, I deal with, the problem is once I get going, I lecture like 10 classes a week. So I gotta upload 10 videos on top of everything else. So, I'll take that into consideration, but it does take a lot of time for me to actually upload and videotape the videos. I could just say, screw it.
Do you have a
Just,
TA?
I don't even need to do the videos.
Do you have a TA?
No, but I'll hire you if you want to be my team.
Like,
And I'll
you
pay you
should
too.
just- If you could have like all the material online, otherwise it's like really hard, cause like all the
Yeah.
homeworks are there, and then
Yeah.
all the videos are there, it's just.
Yeah,
like,
I gotta go back and figure that out. But again, if anybody wants to work for me as a TA, I've tried to get TAs from St. Mary's Over the years, I just can't find anybody who wants to work with me. So I hire from my other universities to help me, because they're motivated to do it. So if anybody wants to work with me, I'll hire 2 TAs and I'll pay you $20 an hour with chocolate.
Under the table. Love videos. I would just say a lot of this information is really, serious professional career words,
Exactly.
and it's difficult to fully learn in a whole semester.
That's correct.
I was thinking maybe for myself, initially, if I kind of had like some stocks, or initially if we as a group had money and we bought it together.
Yeah, I was gonna do a simulated stock portfolio.
Yeah.
But the first part of the class is so intense, to kind of cram all that information into your brain. To layer on another project, I just think it's too much, and students complain enough about the workload already. So to add another thing on there would be really hard. If you're a finance major and you take my international, my investments class, that's all we do is build portfolios. That's all we do is the application. But I'll take it into consideration. I just got to figure out how to fit it in without overwhelming you, since you're already overwhelmed. Okay. But don't feel bad. You'll be overwhelmed when you go into the work world too. So this is a simulated real world environment. Yes, sir.
I was gonna say maybe we go on like E-Trade one day or something like that and just set up like an account on there
cool.
so we can check it out.
That'd be cool. I highly
Go
recommend,
explore
if you're
that.
really interested in this stuff, get an E-Trade account or a TD Ameritrade account or a Schwab account. Like I said before, put $1,000 a month in there for the next 30, 40 years, and you'll be a multimillionaire if you can get 8 to 10% rate of return. And if you can't pick stocks and trade them, buy broad-based ETFs based on thousands of stocks. That way you just track the market. You'll still get your 8% over the next 30 years, and you'll still be a multimillionaire if you can save $1,000 a month for the next 30, 40 years, guaranteed. Yes, Cassie?
I would say like maybe the first day of class, instead of just rushing into everything, maybe go over the vocabulary.
Yeah.
Because seems like even from what other people have said, it's hard to follow along with
I will do that in the future if my students promise they'll read the book. I'll make a deal. I'll slow it down if you read the book. Is that fair? If not, then I'll continue to talk at a very high level, and you'll have to reference, take notes, and then look it up or ask me questions. You could have asked me questions too. Students don't stop to ask me questions because I go too fast. But people are, when you get into the real world, people are going to mow you over. Okay, you're going to have to stop them, and you're going to have to ask questions, and you're going to have to engage, or they're going to run you over. Okay, that's just the way it is. But I will take that into consideration. Thank you for the comments. I appreciate it. Anybody else? No? Okay, so let's go over here and let's do the exit lecture. Hopefully the exit lecture will be 40 minutes, and then we'll end it with the movie. What's that movie you want to yeah, but when you come in, you gotta go in that way. We want to go over there. Okay, so what you got to do now is you got to put your notes away, and you got to turn off your computers, and you got to put away your cell phone. You got to put everything away. Put everything away. Turn off your computers. And I'm going to need your attention. I need everybody to pay attention. If you don't want to sit through this, you can leave. Because I need your attention. I don't mean to be rude. It's just, this is too important. Have an excellent lecture. I designed this lecture about 7 years ago. I used to give it to every one of my students individually. Okay, and it took me hours, but the outcomes were extremely effective. And by doing that, it also allowed me to be able to present this presentation very effectively. I designed components of this presentation over the years, mainly through my advising of my students, and then advising within my practice. I really didn't pull it all together into a 7-module system until one of my friends came to me. She had just become the president of Commercial Real Estate Women, which is a national organization of commercial real estate professionals that are women in San Francisco. She became the president of that organization. And I had sat on the board for 2 years. I was the first guy ever asked to sit on the board of directors of a women's organization, a real estate organization. So she came to me and she said, Larry, I just became the president. Will you coach me and advise me? Because I need somebody that could help me become a great president. So I said, I think I can help you. I've never worked with somebody of your stature before. I usually work with students and juniors and seniors. I usually work with people that are at least 3 to 5 years out of college because I'm trying to prep them to go to the Ivy League or go to grad school or help them in their careers. So I said, give me 2 weeks. I'll put together the presentation, and I'll come back and make the presentation to you, and then you can give me some feedback on if it was helpful, and then you can go off and apply some of the recommendations, and then I'll work with you on an ongoing basis up to the point where you don't need me anymore. So the presentation is really a one-shot deal, and I've kind of smattered a little bit of this, throughout the class, but it's really a one-shot deal, okay? And then what you do, theoretically, is you should try to take notes on this at some point in time. If I work with you on a one-on-one, I basically write up the 22 pages of notes for you, and then give you the notes. And then you would update the notes maybe in 2 days, 2 weeks, 2 months, every 2 years. As basically a strategic plan and a business plan for yourself to be able to make sure that you are moving through your careers effectively, and you can make decisive decisions very quickly and know that the decisions that you're making are correct. Because what's going to happen is you're going to be confronted with some decisions within your career, and if you make the wrong decision, unfortunately, Apple hasn't invented the time machine yet, so you can go back in time and basically correct the mistakes that you made. You can't do that. And some of the decisions you make, if you make mistakes, are irreputable. Okay? Some of them you might be able to overcome, but some you're just going to have to live with the consequences. So this lecture tries to overcome some of those things, and hopefully gives you the intellectual infrastructure to make decisive decisions and know that the decisions that you're making are correct. So the first model is called the nomenclature of knowledge. And basically the theory here is that what I found in my career is that I need to forecast the value of the equity. It could be real estate, could be stocks, could be my own human equity, could be my human equity embedded in my family, in my relationships. So the #1 variable that you need to be able to forecast going up and down is the value of the equity. Now, how do you solve for that? Well, it's really hard, because the value of the equity is basically determined based on where you're coming from academically and where you come from, okay? So the accountants come from the accounting point of view to value the equity. The finance comes from finance, the econ come from econ, public administration, political science, law, philosophy, theology, and what keeps it all together to be able to actually do the forecast is psychology and sociology. Okay, and I'll talk about that in a minute. So each one of these are institutions of thought, institutions of knowledge. And actually the business school, we're in the social sciences as a business degree. It's great because it's cross-sectional, okay? It's one of the most valuable degrees that you can get, I believe. But you gotta know your managerial and your financial accounting and all the factors within that discipline that allows you to be able to forecast the value of equity. You gotta understand the factors within finance and financial ratios and capital markets. You gotta understand economics and what the economy is like within the environment in which you're operating. You gotta understand monetary policy, interest rates. You gotta understand fiscal policy and taxation. And these policies are usually determined at a very high level through the political process. The politics, basically the determination of policy and how it's formulated, and then how it's administered through the institutions are actually going to determine the outcomes and the impacts of positive and negative externalities. And the whole thing here is if you understand that we're talking about an 11 equation, 50 variable each, so it's 11 by 50 factorial to be able to solve simultaneously the value of the equity. Now, I designed this in 1996. There was no big data back then, okay? There was no data computing capabilities that you have now. There was no cell phones back then. So the only way that you could program this and compute this was to internalize it in your brain. Because the brain is the most powerful supercomputer ever designed. It's a biological machine. Your brain transacts 1 trillion transactions a day with infinite storage and infinite data processing capabilities. So you can retrieve the data and the information that you've absorbed, retrieve it, analyze it, get the information, make the decisions, put the information back into your brain to use later on. So your brain is the most powerful supercomputer, and this is basically your operating system. And you have to understand that everything is related to each other, and you got to solve it simultaneously. Computers can do this pretty well these days, but the human brain is more effective, if you believe it. If you believe that the most powerful machine is actually sitting on your head, okay? And then you go ahead and you enable your capabilities with basically a supercomputer in your hand. In your hand, you become an extremely powerful individual. Okay? The question becomes, are you going to use your power for good or evil? What are you going to use it for? And you'll be confronted with this decisions within your career. This actually works because of where we are, okay? You look around you, we're in a beautiful bucolic environment. It's conductive to learning. We're all basically homogeneous to a certain degree. We all speak English. We all use the same language. We're all from the same culture. We all communicate effectively together. We enable each other and communicate efficiently through technology. Those are all ability to be able to learn very quickly and gain knowledge. You can't do it in Mosul. You can't do it in Baghdad. You can't do it in other places in the world where their civilizations and their cultures have been completely destroyed. You can't do this. You can't do what you're doing here, there, okay, which is totally tragic. And then the one thing that I think is the main reflection of civilization and knowledge is architecture. Go to San Francisco, go to Singapore, go to Tokyo, go to Berlin, go to Moscow, go anywhere and everywhere in a major city, and the reflection of their culture and their civilization and their knowledge, history is embedded in their architecture. Go to Mosul, go to Iraq, there's no architecture there. It's completely blown up. There's nothing. Zero. Okay. They have no history at this point. So this model, the main takeaway is it's a machine language. It's how the world actually works. It's social science based. It's a complex system of institutions of knowledge and equations. There's variables in one equation that's also in the other. So if any variables move up here, it's going to move everything in here too. It's multi-institutional. It's simultaneous equation solution. It's multiple regression with big data applications. It's biological processing with infinite storage and infinite data capabilities. That's what you have. That's what you have. The next model is organizational structure, organizational diagnostics, and logistics. Where are you going in your career? Where are you going to go somewhere? Where are you going to land within the organizational structure? You're going to be talking to people at different levels of the organization. Can you switch your logistics, and can you switch your communication style depending on the individual that you're talking to? You can't be talking marketing to a finance person. You got to be talking marketing language to a marketing person. You got to be able to have the language of finance talking to a finance person. When you're talking to the COO, CEO, or the board of directors, or the chairman of the board, you're not going to be talking the same language that you talk to one of your peers within your groups, okay, on your project teams. So you got to be versatile in your, not only your linguistics, but know who you're talking to and where they are, and then start communicating with them the way that they're accustomed to being communicated with. The organizational structure is extremely important from a navigational standpoint, because when you get into a company, you got to know where you are. The second is, what is the path for upward mobility within the company? I'm gonna start off on the project teams, but I wanna become a manager. I wanna become an executive vice president and managing director. I wanna become the president of the company or the CEO at some point in time. How do you do that internally within the firm, or how do you do that external from the firm? Because at some point in time, you may be subjected to a glass ceiling or some type of bottleneck, and you could be discriminated against based on race or gender or age or something like that. And if you're running into those kind of obstacles, you gotta move, okay? You can't stay there because they're basically killing your career, okay? So you gotta be ready to move. You gotta understand where you are. You gotta know how to navigate, and you gotta know how to navigate within the firm and outside the firm. And again, if you're running into bottlenecks and glass ceilings, you gotta be ready to go at any point in time. You gotta be ready to go. So the first thing, the takeaways from this is you gotta understand the organizational structure of the firm. You gotta understand the organizational design of the firm based on the industry and its comparative comparative advantages and disadvantages. You gotta be able to determine your location and the value you add within that position, within the division, within the company, and you need to be able to articulate that constantly. You gotta be able to communicate to people the value that you add in the position, in the division, within the company, okay? And if they don't listen to you, go tell somebody else, because they will then take you. You need to understand how to navigate, to arbitrage your own human capital, and you gotta know how to build and accumulate human capital within those business experiences. You gotta be constantly accumulating your human capital. You gotta be willing to move, and you gotta execute when you do make the move. You gotta be flawless in your execution. And you gotta be able to communicate vertically and horizontally within the firm. You go across functions and vertically within the firm across different levels. And you gotta be ready to go. The third model is you gotta have a plan. Okay, if you don't have a plan, you're being reactive. You're not making strategic decisions. And you're not implementing your strategy through tactics and operational plans. You're just reacting. You're gonna make a mistake, okay? So you gotta have a plan. So here's basically the plan. It's a 20, 30-year plan. You gotta have a 20, 30-year plan. I'm sorry. I know it sounds like it's way far out in the future, but it really isn't. And time's gonna go super fast. And you don't wanna be caught saying to yourself, God, I really wish I would have done that, okay? Just do it, okay? If you wanna do something, do it. Don't wait to do it, just do it and get it done. So what holds you back from doing things? Well, first, you gotta segment out and figure out what your priorities are, what you're willing to sacrifice and what you're not willing to sacrifice. Because you're gonna have to sacrifice something. If you're not willing to sacrifice something, then you're gonna be sacrificing something else. So you gotta figure out what your priorities are. Either it's friends, family, sports, music, whatever it is. If you're willing to sacrifice some stuff for those options, then you're gonna have to sacrifice something. So the first thing is you gotta figure out what your priorities are. Then you gotta figure out time. How much time you're gonna spend doing these things, because time is your enemy, but time is also your friend. So you wanna make time your friend, but it's gonna be your enemy too. So the first thing you gotta do is to get the bachelor's degree. The bachelor's degree is just a ticket to get into the baseball game. It doesn't get you down on the field as a professional player, it just gets you in the game, okay? And then once you get that, and that can take 4 to 7 years depending on who you are and where you go to school, you're in this BARDO state, this training state, this post-graduation state. That basically, that 3, 5, 7-year period, you're really focusing on your career, and you're focused on getting certifications, licensing, and other credentials during that time period. Because what you're trying to do is set yourself up to go to the Ivy League or go to the best master's degree program that you can get yourself into. Why would you do that? You do that because that's where they recruit from, okay? They recruit from the same places that they went to school, okay? And if you get into the best school, the best program, they're gonna come get you. You're not gonna have to go find a job. They will come get you and give you a job. And then you'll be able to decide what you want. So you'll get to choose. During this time period, if you're in accounting, you gotta do the CPA and get that done. If you're in finance, you're doing the CFA, that takes 3 years. If you're in product and project management, you gotta get the PMP certification through the Project Management Institute. If you're in investment advisory, you gotta get the Series 766, the insurance, the long-term care, you gotta get all that stuff too. And there may be other certifications and licensing that you need to be able to do what you wanna do professionally. Then boom, a year or two before you apply to grad school, you gotta get your references, your letters, you gotta get ace the GMAT, and you gotta basically have enough money within this time period to put down as a down payment for your academics. If you have parents, that's awesome. If you get your company to pay for it, that's even more awesomeness, right? Because I had all my stuff paid for by my company. I negotiated it. All 5 master's degrees and the doctorate. I negotiated it. Okay? They paid for everything. So once you get in, it's not even 2 years, it's basically 2 semesters each. Within the summer internship, you're gonna go work either on Wall Street or Washington or in Silicon Valley. They'll offer you a job. You negotiate the buyout of your loans right there. And you say, I want my bonus money to go towards my education. And I want you to pay for my education. So it's not even a matter of affording the 150 or 200 grand to go to the grad school, it's getting in. And once you're in, you're in. And then you can negotiate the buyout. It's easy, okay? A lot of people do it. Then once you graduate, you're in an associate apprentice program underneath the managing director or executive vice president. This is an awesome place to be because these guys want to move up and become a CEO. So when they leave, you move up and you take their position. Boom, you just became a vice president, managing director, and executive vice president because you were underneath somebody who basically saw your talent, mentored you, encouraged you, trained you, and boom, you took their position, which is freaking awesome. Then you can spend 10 years up here and be VP. And then if you want to go to the CEO position, CFO, CEO, COO, CMO, whatever it is, if you want to go to that level, you're going to have to make sacrifices. Okay? You're going to have to make sacrifices because you work 24 hours a day, 7 days a week as the chief executive officer. Okay? The time goes by really quick. Okay? So the way I look at it is if you can implement this stuff up to this point, and if you can generate on average $100,000 a year per year for the next 30 to 40 years, theoretically, you sitting in this seat right now, based on your projected income, is worth $3 to $4 million. You are worth $3 to $4 million sitting there in this seat right now. And that's not even the money that you're going to make by investing correctly. So you could get to 4 and 8 million pretty easily within a 30 to 40 year period, if you can do it. Okay, and I know you can do it. But here's the sad part about it. Now your parents have invested a significant amount of money to get you here, okay? And they're gonna invest a lot of money in you for the next 2 years. So you're worth $4 million. If something happens to you, you get hit by a bus, you get killed in downtown San Francisco, you get a car accident, you get Crohn's disease, you get diabetes, you get cancer, and you don't make it. Now this is reality. I've had students not make it. I've had clients that don't make it, okay? Your parents and your family get nothing. Because you don't, and this is what I hear all the time, I don't believe in life insurance, Professor Souza. I'm young, I don't have a family. You do have a family. You have your brothers and sisters and your parents and your grandparents to take care of. They've invested a lot of time and money in you. And if something happens to you, they get nothing. So all that money, all that time that they invested in you, nothing. And it's really easy to solve. You get a 30-year life insurance policy for $1 million. You pay $400 a year. Maybe even $200 a year because you're super healthy, and if something happens to you, your family gets the $1 million. You just did something for your family. Do it. Get the life insurance. Don't be naive. And if you want to buy a house and you want to do a startup company, the first thing they're going to ask you is, do you have life insurance? If you want a house. If you want to borrow $5 million for your startup company, first thing they're going to ask you is, do you have life insurance? And how much? And are you healthy? Because we're going to get more on you. Because if something happens to you, we can't afford to lose you. And if we do lose you, at least we have the money to be able to invest back in the company to repair the damage because you're not there anymore. Okay? Yeah, this lecture is cold reality, okay, but it's the truth. Okay, and I have no problem telling you the truth. The next model is based on social learning and self-efficacy. Social learning and self-efficacy. Okay? I basically took Albert Bandura's model. Albert Bandura is basically a psychological researcher at Stanford University. He's going to get the Nobel Prize. And actually a lot of people in sports use these models too. Basically what the model is it basically says that what we need to do and what we do inadvertently or cognitively is we identify individuals around us and we model them and model their behavior. We model their good behavior, we model their bad behavior. Sometimes we know it and sometimes we don't know it. Obviously, the people we model right off the bat are our parents. then we're gonna model our siblings, and our uncles, and our aunts, and God help us if we model our friends unless they're really good models that have really good attributes. So basically what you do is you basically model all these people unconsciously. Well, I'm saying be conscious, find people to model, identify those models, identify the attributes that those models have, and basically start behaving and acting out and replicating behaviorally and intellectually those attributes in those models to basically create a target or an ideal self. You're already doing it now. I talk to everybody, I want to do this, I see myself as this. So you've already done it. You've already created an ideal self, created a target self, and here you are here, this is your actual self, here's your target self, this is the cognitive dissonance, the cognitive gap between where you are and where you need to go. So the question is, how do I close this gap between where I want to be and where I am? It's through the process of self-efficacy. It's called self-efficacy. And self-efficacy basically is the process where I want to be like this person, I want to emulate these attributes. How do I do that? I gotta try. So you try and you fail. You try and you fail. Then the individual is broken up into two types of individuals. One that believes that the reason why they failed is a genetic predisposition. The other individual says it's not a genetic predisposition, it's just lack of information. It's a lack of data, and it's a lack of persistence and perseverance. So what I'm going to do is I'm going to go back, and I'm going to continue to do it until I get it. And I'm going to close that cognitive dissonance through the process of self-efficacy. Now, there's two types of individuals that I run into all the time too. I'm a science major, I like math, I like accounting, I'm a numbers person, I don't like individuals, I don't like working in marketing, I don't like working in management, I want to be an analyst, I just want to crank the numbers, I'm really good at it, my parents were accountants and analysts, they did really well, I've seen the success, therefore I'm one of those people, and I have a genetic predisposition towards math and science. Then there's other individuals that say, I don't like math, I don't like science, I don't like the analysis, I'm a people person, I'm really good at management, I'm really good at marketing, I like people, my parents were in marketing and sales and management, you know, I've seen how successful they are, I don't like the math stuff, I don't like the, you know, the analytical stuff, so I'm going to stay over here on the math and the science side. That's the wrong answer in both situations. The top people in these firms, the top candidates, the top students I've run into, basically know that they come into it in one area or the other area through some kind of conditioned responses around the model, the people that they've been modeling, and they realize that it's not a genetic predisposition from one area or the other, they just came into it differently. But they realize that they have to be good at both the sales and the management and the science and the math, so they work on their weaknesses and they become a hybrid individual that's good at both. You gotta go through the self-efficacy process. And you got to go through and be able to take the failures and not look at it as a genetic predisposition. It's just a lack of information, perseverance, and trying. Now, if you can go through this and you can harness this, the outcomes are tremendous, okay? They're amazing. Because what you end up getting from all of this up to this point is when you walk into a room, you have presence, okay? You will command respect from people. They will be gravitated towards you. Why? Because you have a very strong personality. And you can communicate very quickly through your dress. That's the first thing they do. They will size you up in 2 seconds by the way you look. So you have the presence, you have the dress, you have command over the language, you have to communicate with people extremely precisely at their level in their language. You're a very good communicator. You have charisma. If you have charisma, you're going to be a leader. People are going to follow you. You're going to be able to persuade people to do things that they otherwise don't want to do. And people don't want to do things. So how are you going to get them to do it? You got to be able to use all of those tools. And people are not only motivated by money. In most cases, they're not motivated by money. They're motivated by other people that they want to work with and the people that they work with. That's what motivates them. So you have to be charismatic, and you have to be able to take on that leadership role. Once you can take on that leadership role, you will then have the power of persuasion to be able to get people to do things that they otherwise wouldn't do. The last thing, which is the most important thing, is if you can do all this stuff, you become a model for other individuals. you become a model to other individuals. They will start to gravitate towards you. They will come to you. They will say, take me with you, hire me, coach me, talk to me, meet with me. And then it's going to be up to you to decide who you take with you and who you don't, who you talk to and who you don't, who you coach and who you don't. You'll have to make those decisions. And it's excruciatingly painful to say no to somebody, either because of lack of interest or unethical behavior or extreme neuroses or psychotic behavior of some sorts, but you're going to have to make the decision, and you get to choose, and you'll be able to take people with you and make them successful with yourself. Again, how do you do all this stuff? You got to be extremely organized, extremely organized. I get questions all the time. How did you do it? How did you work 25 years? How did you teach for 25 years? How did you get 2 undergrads, 5 masters, and a doctorate degree simultaneously? How did you do it? Not necessarily why did you do it, because I know why I did it. And I did know why I did it from the very beginning. I just couldn't communicate it with people because they didn't care in most cases. And I was telling them my vision and they didn't care, okay? They were just projecting their own insecurities and their own vision onto me. They didn't care, okay? If you can find people that care, get them around you. But get other people that have negative aspects, and if they distract you, hold you back, if they're giving you negative, tell them what they want to hear and move on. Do not deal with them. They will hurt you. They will slow you down. So the first thing you need is the strategic plan, right? You got to lay out a 5-year plan, okay? And you got to rank your objectives and your goals from high to low over the next 5 years. That's how I did it, okay? And you got to update the plan every year, going out 5 years. You already learned this stuff in your class. And what you have to do too, because life does change and things come up, you might have to push some of these priorities down, or you might have to push them out. It doesn't matter. It's got to be fluid, because the only thing that matters is you achieve your objectives. I don't care if I achieve my objective in 3 months, 3 years, 30 years. I don't care. It took me 14 years to get my doctorate degree. I knew I was going to get it. I got it. That's all that matters, right? Time doesn't matter. It's getting it and doing it. Then you have to have a tactical plan laid out, where you're basically breaking up. Excuse me, are you looking at your phone? Did I ask you not to look at your phone? Okay, you just totally distracted my train of thought. Now, what was I talking about?
Tactical planning.
Oh, thank you. Tactical planning. So you go out 3 years, and then what I do is I hack up the years into 6-month increments, or I do it on a quarterly basis, and I lay out more micro-level goals and objectives. Again, I know exactly what I'm doing, what my goals and objectives are at all periods of the time. I know what I'm shooting for. If you don't, you're wasting your time, okay? Next, you gotta go to the operational planning. I usually go out 1 year in advance. This is a great time of year to basically lay out all your major milestone dates that you need to accomplish over the next year, okay? And put those milestone dates on your calendar, and then start backing into those milestone dates to basically reserve time that you need to be able to prepare so that you can meet those milestone dates when you need them at the most. And then the most important plan is your weekly plan, where you're basically booking and looking out at least 2 weeks on a rolling basis and completely booking yourself and booking out time so you know exactly what you're going to be doing every minute of the day, going out at least 2 weeks. It's extremely important, because then you block out the times you need to block out. You got some available time. You can start putting people and stuff in those areas. And the world revolves around the same time schedule, which makes it extremely efficient, because from 5 to 8 a.m. in the morning, that's basically open time. Then you get from 8 to 9, you're going to work. Then you go to work from 9 to 12. Then you got 12 to 1, a lunch break. Then you're going to get off at 5, and you're going to go somewhere by 6, and then you got 6 to 11. So I hear, I don't have enough time. You have enough time. You just didn't organize your time correctly. You have plenty of time. You just didn't, you weren't efficient in actually doing it, okay, and putting it together. If you implement these programs, and if you can execute on these things, you're going to be an extremely successful and an extremely wealthy person, guaranteed. On top of maybe the wealth that's going to be transferred to you by your grandparents and your parents. And a lot of you I know I did, I expected wealth from my grandparents, and I expected wealth from my parents. What I found out was my grandparents didn't have any money, and my father went bankrupt. So he had nothing, okay, when he passed away. So I got nothing from them, okay? So I had to build everything myself. And I've seen it too with my clients too. My clients will come to me and they say, Larry, put together a plan for me. It's like, here's the plan, you need to execute on it. I don't have time to execute on it right now. Okay, great. 1 year, 2 year, 3 year, 5 years go on. All of a sudden, somebody gets cancer, they need the money, they don't have the money. They didn't implement the plan. Somebody sued them, took their assets. They don't have the assets anymore. They sued their business. Now they don't have the business is impaired. They don't follow the plan. Okay, if you follow the plan methodically, it's like the hare and the tortoise. Do you know that fable? The hare and the tortoise. Yeah, who won the race?
Tortoise.
Exactly. So you plot. You don't need to kill it. You don't need to be overly risk-taking. You just stick to the program, and you're going to end up with the $8 million, guaranteed. Okay. So where do you put the money? Okay, and they don't teach you financial planning in corporate finance. They don't teach you financial planning anywhere in the university, and you all now are at that point where you are emancipated adults. You are expecting wealth to come down, but I'm not convinced that the majority of you know where the wealth is. Are you on the bank accounts? Are you on the will? Are you on the living trust? Are you on the deed? Are you on those documents? If not, then your sister's going to get the money. Your brother's going to get it. The business partner's going to take it. The government's going to take it. If you're not on it and you think you're going to get it, you're not going to get it. Okay? Somebody's going to steal it from you, guaranteed. There's not very nice people out there, especially when it comes to money. I've seen it. I've seen families been destroyed over millions of dollars. They got millions of dollars. They didn't care. They got their 10 million bucks. Forget dad. Forget mom. I don't care. I want the 10 million bucks. I don't care if it destroys the family. I've seen it. Okay. So you have to be really smart. So the first strategy is really a tax arbitrage strategy. You want to put money in your 401k. If you can get the employer to match your 401k, that's awesome. Get them to do it. Okay. It's basically free money. And again, if you can put $1,000 a month in your qualified account for 30 years, you can get an 8% rate of return. You're going to have $3 to $4 million in there, guaranteed. Okay? So you want to invest aggressively in the qualified accounts. That's the 401k, the self-directed IRAs. Unfortunately, at some point in time, you're going to make too much money, and you're going to have too much money in these qualified accounts. You don't pay any taxes on these until you start pulling money out. And you can start pulling money out at 59.5 without any penalty. But the government's going to come to you when you're 70.5 and say you got $3 million in your qualified account, apply this formula and start taking the money because we want our taxes. Okay, so they'll force you into taking the taxes. So you want to put as much money as you can in here, and if you're self-employed, you're going to do a SEP program, and you're going to put 50 grand a year in that thing. I always recommend to my clients do the defined benefit because I can pump $250,000 into the qualified accounts, the defined benefit program, pre-tax. It's freaking awesome. You do that for about 8 years, boom, you're done with this side. Now you're being forced into non-qualified or the after-tax realm. You got to pay your taxes over here. Where are you going to put the money? You're going to put it in real estate. You're going to invest in businesses. You may do a Roth IRA where you already pay the taxes up front. You can pull the money out in the future without paying any taxes. And let's say all of a sudden the stock market and your real estate go through the roof, and you've set a 50% wealth constraint over here and 25 over here, and now this has pulled you up into 75%. You liquidate the assets to get back to the 50%. You take that money, you bring the money down here into the safe after-tax realm, into municipal bonds, life insurance, guaranteed annuities, and you build an annuity so that you never run out of money, and you have enough money to give your kids and your family when you die, efficiently, without taxes. Okay, so that's basically the strategy. How do you invest the money as the tortoise? Well, here's the menu. First thing you do is you put together a risk management plan. You get the life insurance. You get convertible term insurance. That allows you to be able to convert the term insurance to permanent insurance. Permanent. Premiums are going to go up. but you're building cash value. I can pull out later on in like 10, 15 years, I can borrow on the cash value, pull money out tax-free. I can, it accumulates, the cash value accumulates tax-free within the life insurance policy. And when I die, the death benefit goes to my heirs, and if I don't pierce the estate tax ceiling, it goes to my heirs tax-free. So life insurance is a pretty awesome investment vehicle. Professor Sousa, I don't believe in it, I'm too young. Okay, that's what I get. All of the rich guys, all the rich people on the East Coast here in the Bay Area, they have a ton of life insurance because they understand, and their advisors are advising them. Their attorneys and accountants and investment advisors are telling them you need a ton of insurance. You can also convert it into variable universal life. Variable life, which means that there's a range of premium that you can put in, and the money goes into an account that invests in the stock market, and as the stock market goes up, the cash value goes up, and your death benefit goes up too. So people within the 40 to 50 range like the variable universal. Long-term care, I don't care, okay? I got kids, they're gonna take care of me. Great, well when you can't do 2 daily functions, you're gonna go into a care facility. Care facilities could cost $200 to $400 a day. Now you're gonna drain through all of your wealth, and you're gonna drain your kids' wealth down too. So you gotta get the long-term care insurance. And the idea is you set up a C corporation, you set up the long-term care for you and your spouse or your partner, and you basically run the long-term care premiums through your C corp, paying for them in pre-tax dollars. That's freaking awesome. And then you don't have to worry about anybody taking care of you when you get too sick and too old. Disability insurance, you need that too. And actually they're gonna slap disability insurance on you where you go to work. As you get further up in the company, they're gonna put life insurance on you, and they're gonna put disability insurance on you. Because you need the money if you ever become disabled. If you own real estate, you're gonna need property casualty and probably earthquake insurance. If you don't get enough insurance, your place burns down. People in Napa, if you have an earthquake and your property gets impaired and they red tag your building and your tenant's got to vacate the building, you don't have the money to pay the mortgage. You're going to default on the mortgage, the bank's going to foreclose on the property, they just took your property because you didn't get enough property casualty insurance. Okay. Business umbrella insurance, if you want to go into business by yourself, you're going to get sued. Okay. You got to get the business umbrella insurance, you got to get the badass attorneys from New York to come out, basically take out the individual that's trying to sue you to take your business and steal your money. So you got to have that too. On the investment side, you got qualified, non-qualified strategies. You got your 401k, you roll it over into a self-directed IRA. Never leave your money at another company because they could go bankrupt and take your retirement accounts. Problem with the IRA is you got stuff in there, you're naked to the markets. So if the markets crash, your retirement account goes down. The way you get around that is you roll the money over into a variable annuity, invested in mutual funds and ETFs, and you apply the guaranteed investment protection rider. They're going to charge you a point, okay, 1 percentage point on the assets under management. What you're doing is you're basically buying a 14-year put option. So if the value of your money, let's say you put $1 million in, and all of a sudden the market crashes 50%, since you bought this guaranteed investment protection rider, the insurance will give you the $500,000 and make you whole, so you don't lose any money. Then what you do over time as your assets start to appreciate within the account, you basically lift the floor, the exercise price, lock in your wealth, so if the money goes, if the markets go down, the insurance company compensate you. So you're able to do it 3 times over like a 14, 18-year period. So New York Life invented that product. Amazing. Also the guaranteed future income annuity. You can put money into that too. I got $1 million, I'm 50 years old. I give it to the insurance company. By the time I turn 70, the insurance company gives me $100,000 a year for the rest of my life, and maybe my life and my wife's life. Guaranteed. So if I live another 10 years to 80, I got all the money back that I gave them. If I lived to 90, I pulled out an extra $1 million. If I lived to 100, which is highly probable, you guys will probably live till you're 100, that you pulled out an extra $2 million. Okay? So it basically guarantees that you don't run out of money, because you may run out of money. That's the biggest problem. with most people. And then when you turn 90 and 100 years old, you put your money into these fixed annuities because you don't care about the markets anymore. You just want enough to live off of until you expire. You're going to max out on this area here, and you're going to have to move money over into the non-qualified side. Stock brokerage account, you're going to put money to work in equities, I hope. And then when you need the money, you're going to liquidate the equities, and you're going to pay the difference from the cost basis and the price in which you sold it at. That's going to be your capital gains, short-term or long-term, depending on what it is. People love to put money into these variable annuities with these guaranteed investment protection riders after tax, because there's no limit to the amount of money you can put in, and the money accumulates within the account tax deferred. And if you die, it goes very efficiently to your heirs as beneficiaries. So people use this a lot. You can also put as much money into these guaranteed future income annuities. And what's amazing about that in the after-tax realm is as you take the $100,000 per year, you don't pay any tax on the $66,000. You only pay tax on the $33,000. Because the IRS basically said that the money that you gave us, you're taking a return of the basis as you're getting paid the $100,000. So you've already paid taxes on it. You don't have to pay taxes on it again. And you can also do the fixed annuities there, and you're also going to invest in real estate and businesses because you can accelerate depreciation and you can depreciate your assets, which basically means you're lowering your taxable income by using these assets. And you can run a lot of your expenses through the real estate and through the businesses, thereby collapsing your after-tax expenses. That's basically eating up the majority of your income. And then the last piece is basically wealth transfer. You're going to accumulate a lot of wealth. Your grandparents may have a lot of wealth. Your parents may have a lot of wealth. The question is, do they have a plan in place to mitigate the tax damage that will basically be inflicted onto the portfolio and the estate if they don't have a plan, okay? And what you do is you usually segregate out the assets into assets that can't be put into an irrevocable trust, okay? So these are assets that are outside the irrevocable trust. There's probably a living trust that tells where these assets are going to go efficiently to circumvent probate. But if you got assets, your real estate and your appreciated stocks in the irrevocable trust, when you pass away, the assets will go to the heirs at a stepped up basis and they don't pay any tax. Boom. Okay. So there has to be planning around that too. And the irrevocable asset protects the assets. The living trust just tells where the money's going to go. Now you probably have mortgage debt or debt accumulated in these assets. So you'll definitely have taxes on these. And when you get these assets through inheritance, the IRS is going to show up and say, well, you need to pay the taxes on them. Well, I don't have the money. Then you're going to have to liquidate the assets. Well, what if the assets don't meet the tax liability? What if I liquidate these at a deep discount because they're illiquid and I don't have enough money to pay the taxes? Thanks, Mom. Thanks, Dad. You just left me with a tax liability. That's awful. So what's the solution? The solution is you set up an irrevocable life insurance trust. You basically make the trust the beneficiary of the life insurance. So you take some of the money here and you pay the premiums for the life insurance. The death benefit, when you do pass away, the death benefit goes into the irrevocable trust and it extinguishes the tax liabilities. And if you have enough life insurance, it extinguishes the debt. So basically everything goes to the heirs, debt, and tax-free. Thanks, Dad. Thanks, Mom. That was freaking awesome. You just helped me out a lot. You took care of me. So that's just good planning. We're definitely going to have to deal with taxes. You're going to have to be smart about taxes. Taxes will kill you. I don't know about you, but I love taxes. I really do. I just love taxes. I love income taxes. You know, between 39 and 70% of your income go into income tax. I love that. Oh, and the state loves to get its fingers in there too. They'll charge you like an extra 10, 12%. Love that from the state. More than happy to pay. I love capital gains tax, short-term, long-term capital gains. Love that too. Recapture tax on the depreciation I took on my property at 25%. Love that too. Bring it on. I love retail sales tax. Everywhere I go, I got to pay an extra 10% tax to shop in San Francisco in Union Square. There's probably other taxes in there that I love too. I just haven't identified them yet. Whew. Yeah, there's a lot of taxes. You need good tax policy. And then the last is estate protection, asset protection. Okay? First thing you need is a will, okay? Larry, Professor Souza, I don't need a will. I'm only like 20 years old. What do I need a will for? You need a will that has a medical directive in it, okay? Because if something happens to you and you get put in a hospital and you don't have enough insurance and you need special procedures or special type of medical care, your parents are going to blow through the retirement to keep you alive. So you need to have a medical director in your will. That basically says if I can't be revived, if I go into comatose and it looks like I can't be brought back, pull the plug, don't blow through all of your wealth, don't take everybody out in the process, just take me out, and that way we'll mitigate the damage. I'm just being brutally honest, okay? And I know people don't talk about this stuff to you because it's hard to talk about, okay? I gotta talk about this with my clients because they don't think about it and they avoid it. And then they come back to me when something happens and they say, tell me about that strategy, Professor Souza. I wanna do that strategy you talked about. Well, tell me what happened. I can't do it, something happened. I can't go back in time and do it. You gotta do it up front. You gotta be proactive. The next is a living trust. That will circumvent probate. That'll tell you where the assets are going. You guys are gonna have some good conversations with your parents over the holidays because you have to have these conversations with them. Because if you don't, you're not gonna get it. You're gonna lose it. Okay? You gotta do this. This is all best practice. This is all advanced planning that I give my clients. The irrevocable trust, okay? That's the one over there that passes on the assets at a stepped-up basis. Oh, this is one of my favorites. These two are my favorites. The Dynasty Trust and the Generational Skipping Trust. These are awesome. This is the morning, probably you're still a little hungover. You get the call, you're about 35 years old, maybe 40 years old. You get the call from your mom. It's like, oh, hi, Mom, how are you? Oh, yeah, I love you too, Mom. What? You did what? Honey, Mom set up some kind of dynasty generation skipping trust. She said that we're so successful that we don't need the money. They're gonna give all of their wealth to our kids. So we get nothing. Okay? Your kids are gonna get it. So they skip the generation. Okay? A lot of the rich people do that stuff. But that's a good call. You might get that call. Okay? Not yet, maybe in like the next 10 years, but you'll get that. Charitable remaining trust, you throw the assets in there, you basically pull out the basis and a little bit more, basically no taxes, and then the asset, when you pass away, goes to the charity. Okay? And you can probably buy yourself a seat on the board of directors too, by leaving them the $10 million apartment building. And then there are other intentionally defective trusts and other types of trust structures, depending on who you are and what your family situation is. If you're a foreign national, if you're a green card, if you're coming over through an EB-5 program or some other type of foreign programs, we have other types of trust structures that we can engineer to basically mitigate the tax damage, to asset protect all of the assets and then transfer the assets to the heirs in a tax efficient and efficient way. Okay, that's it. Look at me as a resource, letters of recommendations, references. Somebody's going to call you, Professor Souza, about a job application. Great, you've been working with me over the last semester, over the last year. I'm really comfortable giving you a phone recommendation. I'll write you a letter of recommendation. I will refer you jobs, internships, jobs. I will place you. If you want to be placed, I will coach you. I will do anything that you need me to do. Just don't be scared to ask, I'll do it, okay? Because that's my job. Okay? You're my human equity. You're my investment. Okay, thank you.
Thank you.
All right.